Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. It's Tuesday, the 22nd of August. My name is Russell Shoma, Senior Market Specialist at FXCM, and I'd like to draw your attention to my email address, rshore@fxcm.com. If you would like to contact me, that is the email address to use. Just going to go ahead, bring up our disclaimers, and we'll start off with the high-risk investment warning. Hey Mia, good morning to you. Welcome and thank you very much for joining. Pleasure to have you all on the Morning Market Review. It is highly appreciated. All right, here is our market commentaries disclaimer. And of course, our references, Marketscope and TradingView. All right, the analysis starts off with the US dollar. Just going to bring this across. And it's interesting. It does look as if there is some sort of key reaction that's happening at this resistance level. The issue at the moment, which we've discussed, is that we are at least one price candle shy of a signal. So the idea here is, are we going to get another key reaction at this level here? And even though we do have some red that has appeared, it's not really good enough. This is what we call an inside period. It's an inside period. Now, we've only had really one day of trade, haven't we? So to be fair, the week isn't over. We don't know what type of candle this is going to be. But in order for it to be a key reference candle at a key reaction level, we really needed to close below last week's candlestick. And the fact that we don't have it below that yet does provide a conundrum for us, because we need to assess, are we actually having a pullback in the US dollar at the moment? Now, the problem with the markets at the moment is that the dollar is not trending. It's much easier to trade trends than it is to trade trading ranges. Trading ranges, you have to be a lot more specific with your market timing, and we all know market timing is extremely difficult. What you can see here, if we have to put in peaks and troughs, we've got a reference peak over there, and we've got the reference trough over here. And if we put the lower peak in there and the lower trough, up until that point, it all looks pretty good in terms of trend determination. But then this now is actually a higher peak. Okay, so it breaks the downtrend. So we don't have a trend anymore. We don't have an uptrend either. An uptrend has got a very specific definition. It's a higher trough followed by a higher peak. We don't have the higher trough. We've just got the higher peak. So we're missing a point. So the idea here is an a-directional market or a consolidation. And that consolidation now is right at a key reaction level, and that key reaction level is resistance. But the price action is shy of giving us a true signal. If you take a look at the RSI, it's above 50. Okay, so there does seem to be some sort of underlying bullishness. Now, given that, you go through to the daily chart. Yesterday's candle, what kind of candle did we have yesterday? Take a look. Sorry, I just want to get an upwards arrow here. What kind of candle did we have yesterday? We had doji. What candle did we have on Friday? Doji. What candle did we have on Thursday? Doji. So what are dojis? They're candles of uncertainty. 3 candles of uncertainty all in a row. Not only that, to just emphasize the uncertainty that we're at, Friday's candle is an inside day. It's all inside Thursday's range. Monday's candle is an inside day. It's all inside Friday's range. Okay, so we've got this huge uncertainty here. So how do we analyze it? I think that we've got to recognize we are at resistance. That's going to make life complicated for us. I think that we have to recognize that the swing is to the upside. We don't have enough information to say the swing is to the downside. So we're swinging right into resistance. The question now, and it's been asked in this forum before, are we going to react in the resistance level? And that remains to be seen. But we do have an underlying positive momentum. We go down to the daily chart. We are in zone 1. Zone 1 between the upper blue, the upper red. Now we've had 3 days of uncertainty. 3 days. Do we get some sort of direction today? That's going to be the key question. We go down to the hourly chart, okay, and you can actually take a look how difficult the trade has been over the last few days. Is just one big sideways movement. Nothing there. Okay. Nothing there. Very difficult indeed. So what we're looking at now is we're looking at the R1 as a potential support. Okay, why the potential support? Well, S1's a support pivot. We are in the bullish channel between the upper red and the upper blue. We do have the RSI, the daily RSI above 50, okay? And now we're just waiting to see if we get some sort of trigger. A trigger would be the trend following indicator, doing a golden cross, a bullish cross to the upside. And we would need to see the stochastic cross to the upside as well. We don't have those signals yet, so it's very much a game of patience, isn't it? So this game of patience can be frustrating, but the truth of the matter is, guys, we are in a very difficult environment here. We don't have a trend. We are right by a key reaction level. We've got an inside week. We've got 2 inside days, 3 dojis, and it just smacks. It really smacks of uncertainty. So the idea here is, do we get the bullishness coming through now? And that bullishness would effectively line up the hourly with the daily chart. Okay, so we're using the daily chart as a filter here. What could happen? And we could fall into no man's land. That would be a movement from zone 1 into zone 2. That would be relative weakness. It could happen simply because there is uncertainty and we're at this key reaction level. And after 3 days of these dojis, we might just the bulls just might be exhausted, and we might get the dollar dropping into zone 2. It's all very much a hypothesis at the moment. It's very theoretical as opposed to practical. So we want to just see if we can get some sort of triggers here and some sort of alignment synchronization between the time frames, and that would put us on a better wicket, better batting wicket. But at the moment, it's very slippery indeed, extremely slippery. We just see there's some questions coming through. Hey Howard, morning to you. Yeah, 3 dojis. How to add R1 and S1. These are pivots. You go through to your add indicator, type in pivot and add in the pivot levels there. Okay, so that's how you add in the R1s, R2s. Go through to the pivot indicator on market scope. All right, let me know if that answers the question. A few things that we have to look at in terms of the fundamentals. So Kim's saying, so do we stay away, or is it possible to look at other pairs? Kim, my preference is to trade trends over ranges. So again, it comes down to your trading plan. You've got to have a trading plan that deals with these situations. If your trading plan is looking to trade trends, then we don't have a trend. Well, there's the answer. The idea here is patience. Not taking a position is still a position. Okay, it's about approaching the market where the odds are completely in your favor. If the odds are not in your favor, why trade? Why trade? Okay, so it's really about lining up the putting the ducks in a row, so to speak, lining those odds up. All right, I wanted to show you guys some fundamentals. Let's just go back down to the yields. There's a few things I want to show you here. Just bear with me. This is a 10-year yield. Okay, this is a 10-year yield. It hasn't gone overbought yet. We're looking at a weekly. If I go through to the daily, it still hasn't gone overbought. What I can do is I can make this into a real interest rate, and we can do a similar type of exercise there. So what I'm going to do is I'm just going to subtract the break even, okay, off of the 10-year. And what we want to do is we just want to take a look at the, so on the real rate, perhaps on the daily, tending towards an overbought level, okay, but not quite there yet. So maybe some sort of respite coming in from yields. I'm not certain. If we go through to the weekly, we're not overbought there yet. Okay. What effectively happens when you get high yields like this? It's effectively showing you a sell-off in the bond market. Okay, the bond market is getting absolutely creamed at the moment. What I want to show you is an instrument called IEF, which is an exchange traded fund for about 7 to 10-year bonds. Okay, but now we're not looking at yields. Now we're looking at prices. Okay, so just bear in mind we're looking at the prices, not the yields. And here you can see how the bond market, let's just go through to a monthly chart here. You can just see how the bond market has been absolutely smashed. Okay, let's change this to logarithmic. And you could just, here is the first trend line. Okay, here is the second trend line. And here's the third trend line. So the third trend line just shows a waterfall type of effect, how the bond market has completely capitulated here. Now, what I suspect, okay, what I suspect is that the bond market represents a lot of value for bond investors. So we'll come back to IEF. No, let's keep IEF there. Let's take the RSI out. I'm just going to go and put the 10-year yield underneath that. Okay, I'll put the 10-year yield underneath it. So the 10-year yield is at 4.34%. So it's what bond investors can do is they can buy a bond and hold it to maturity, and they'll be getting around about 4.34% if they hold to maturity. If they're trading it, it's a different story. But if you hold to maturity, you lock in the coupon, right? I think there is some value here, but you know what I think and what happens are two very different things indeed. Even though I may think there's some value here, we need to see some sort of purchases, some sort of demand coming in for the bond market. The way that we can monitor that is we can just throw in a trend following indicator. We could throw in our triggers. So what we can do is, just for example, we could put in, let's go through to daily here. What we can do is we can add 2 indicators. I'll just make them 2 exponential moving averages. And we've seen this before. We can change the settings of the exponential moving averages. The first setting is 5. I tend to make that green. And the second is an orange, and I tend to make that 10 periods. And then the idea here is for the golden cross, some sort of signal just to suggest that buyers have become interested in the bond market. If we take a look at the weekly, we're still in bear mode here, aren't we? We can even add in a stochastic. Okay, let's go ahead and add in the stochastic. That's our second trigger. Okay. And it's really just moving down at the moment. We've got to get some sort of bullishness in there, And what would happen once we get the bullishness in the prices? Then the yields would start coming down. If the yields start coming down, I think we get a pop in the risk markets. I think we get a pop up in the stock market. We did discuss that yesterday with the time value of money. You can go back onto our YouTube channel and take a look at that. And I think that the resistance area for that US dollar kicks in then. But this is all very much conjecture. It's hypothesis. We've got to get the pop. We've got to get the crosses in the moving average. But I just wanted to show you what's happening in the bond market. Bond market is getting absolutely creamed at the moment. Okay, and that's causing all sorts of dilemma for us as traders, because it's been reflected in yields, and those yields are trickling through to the dollar. The dollar's not trending, and then the lack of dollar trend is going through to other instruments. All right, there's one other fundamental relationship I want to show you. I want to show you the German 2-year. Sorry, let me just do that again. The German 2-year. So we're looking at a proxy for European Central Bank minus the US 2-year. And the reason that I'm putting the German 2-year first is because euro comes first in the euro-US dollar pair. And what I want to show you guys here is, let's just take off the moving averages. Got a head and shoulders that has appeared in the spread between the German 2-year and the US 2-year. The way that I'm interpreting that is that the ECB is actually losing power in terms of how aggressive it can be in terms of its monetary policy. And the reason that I think that it's losing its power is because the economic data coming out of Europe is quite poor. Retail sales, manufacturing, much weaker than in the US. GDP growth, much weaker in Europe than it is in the US. And I think that the head and shoulders pattern in the spread here is reflective of that. And if you add the euro-US dollar to that, okay, so we'll just add that underneath. In particular, let's just zoom in here. In particular, it's starting to put a pressure on the euro-US dollar. Okay, so that's interesting. All right, so I just wanted to show you that the spread here and the relative monetary policies here, I think, are also one of the reasons that the euro-US dollar is floundering. And of course, we can tie that straight back to the fact that US yields are being driven much higher. So again, there does seem to be, in my estimate, an argument to be made for potential dollar strength. The problem here is, of course, we don't have the synchronization between the hour and the daily. Okay, the fact that the weekly chart is showing uncertainty, the daily chart showing uncertainty, and now we just want to see if we get some sort of synchronization. Before we get that synchronization, I would suggest patience. Not having a position, still a position. Look after your trading capital. And when things become more apparent, when there are more obvious trends, I think that we'll have a completely different discussion. All right. Is there any questions? Please go ahead and type those in. Tomorrow we will do the crypto minute as well. Tomorrow we'll do the crypto minute. Nothing coming through, so I'm going to conclude at this point. I want to thank everyone for signing in this morning. It's very much appreciated. And of course, have a phenomenal day ahead, a great evening, and we shall chat tomorrow morning. Thanks very much, guys.